Good afternoon and welcome once again this afternoon to Getting Started with Technical Analysis, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Brent Moores, 20 and then some plus year veteran of the financial markets. Brent and I have been working together for at least 20 years, and so it's good to have Brent out there in the chat helping to answer your questions and keeping the conversation going. If you are here with us live, thank you for being here live and chat in your questions. Keep those questions going. If you are here in the recorded version, thank you for joining us in the recorded version. We're glad to have you as well. Leave us a comment in the comment section. We will get back to you as quickly as we can. Now, today, this particular class is the start of a new cycle. And I always think about that when I think, wow, we're the beginning of a new cycle. Back in high school, I did something. I listened to Wagner's Ring Cycle on purpose because I thought it would be cool to do that. Believe me, I know the comments about me being a opera nerd are flying fast and furious at the moment, but I listened to Wagner's Ring Cycle. So I think this is a little bit less burdensome. The Getting Started with Technical Analysis cycle, a little bit less burdensome than listening to Wagner's Ring Cycle. Probably a lot more beneficial for you, hopefully. And I'm going to try to make it a lot more fun. So a couple of quick reminders as we get into this discussion and get started so that we can talk about what that cycle of the Getting Started with Technical Analysis webcasts looks like. Remember that everything we talk about, simply for illustrative and educational purposes only, it is not a recommendation. It is not any kind of advice or endorsement. If we do happen to talk about options content, which would be incidental to this webcast, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, when we talk about technical analysis or we talk about fundamental analysis or probability analysis, the big thing you have to remember is that no method of analyzing the market, whether it's technical analysis, fundamental analysis, probability analysis, can guarantee or predict what the market is going to do. And as such, Schwab doesn't recommend the use of technical analysis as sole means of investment research. All of those are theoretical ways of looking at the market. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version of the platform, which is a great learning environment. It's a great sandbox to play in. It is not, however, a guarantee of future success out there in the real world. Investing does involve risk, including the loss of principal, past performance, and this is key again to the understanding of technical analysis, that past performance is no guarantee of future results. News happens. So keep these things in mind as we get into this discussion a little bit further, as we get into this cycle. Now, here is the cycle of the Getting Started with Technical Analysis webcast. And that cycle really is exactly this. It is this process of understanding the introduction and the beginnings of technical analysis. It is the process. Let me do this real quick. I gotta delete something here. Let me get that off of the screen. I don't know why. There we go. Okay. Introduction to technical analysis, which is where we're going to spend our time today. That's understanding the concepts, the background of technical analysis, some of the characteristics, some of the tools that we have. Then in the next lesson, next week, Barb's going to talk about trends and moving averages. And then she's going to discuss support and resistance, and then candlesticks, and then price patterns, and then price patterns, and then price patterns, and then technical indicators, and then divergences. And then we'll cycle all the way back to the beginning. So this is the kind of really out of the box beginning introduction to technical analysis, understanding the characteristics of technical analysis, what it is intended to do, what it cannot do, what it is not. And that's where we're going to go with this discussion today. So I'm going to try to answer some of your questions along the way as best I can. Brent's going to be there to help out and help to understand and answer some of those questions along the way. But we're going to focus on, yeah, I think probably so, Brent. You're absolutely right. A little bit faster than listening to the ring cycle. So our agenda for today, we're going to talk about what and why. What is technical analysis? Why do we use it? Some of the principles, the charting basics, and charting key points in this discussion. So let's talk a little bit about the goals of technical analysis. It is not to predict what is going to happen tomorrow or in the next hour or in the next tick. I know it would be great if that were the case. If technical analysis, some way, if there were some kind of technical indicator that we could pay for or have access to or write or script that would tell us what's going to happen in the next tick, the next minute, the next hour, the next day, the next year. That would be phenomenal. Problem is, nothing can, because news happens. We can make projections. We can make forecasts about what might happen with a reasonable amount of probability. But as Ricebird says, we do not have a crystal ball. We cannot predict. And things can and do change. News happens. Here's a question, guys, that I get all the time is, how would I be able to know the news, or how do I look at a technical indicator that's going to tell me that this circumstance was going to happen before it happened? And I look at sometimes I look at people when they ask that question and I say, well, wait a second. You want me to tell you the future? That gets back to the crystal ball. News happens, and news cannot be predicted. Now, there's a difference between a known news event and a news event that is emergent. A known news event, something like an earnings announcement, we can predict when it's going to happen, but we don't know what its result is going to be. We can take into account the fact that, if we've got a Federal Reserve meeting like we do tomorrow, that there's very likely going to be movement in the market, but we can't predict what that movement is going to be. So JDM asks question, can Thinkorswim alert us to news instantly? Well, instant is kind of an interesting question, isn't it? Because at some point, somebody's got to process that news. And they've got to put it into a news feed, and it's got to be accounted for, and then it's got to be disseminated. So there's going to be mechanical latency or lag in those news items. There's also going to be that latency in terms of just simply the delivery and getting it from one person to another. The problem is, unless you are there when the news happens, if you are in the room when it happens, then maybe you're going to know before much of the market. Or if you're creating the news, maybe you're going to know before much of the market. But if we're just watching a news source, whether it is a social media news source, whether it is a news source like, say, for instance, quote unquote, a Bloomberg terminal, something that is paid for, a paid news source, or whether it's a free news source that comes with your utilization of something like the Thinkorswim platform, there's always going to be a lag, and the market is going to know before we do. And so the market's going to react. So trying to trade ahead of news, getting out ahead of news, becomes a self-defeating prophecy, because we spend a lot of time trying to do that. And by trying to predict that, we put ourselves in a situation where we're being reactionary. So technical analysis, being the study of historical price and volume to identify and project price trend, is largely based on probability. The fact that when we see something happening, there is a tendency for it to repeat itself, right? So that if we see a trend continuing to move in a particular direction, that it's likely to continue to move in that direction. Or if we see that the price of a stock has reacted to a particular news event or an earnings announcement in a particular way in the past, it may be likely to move in the same way the next time, but it doesn't always. So fundamental analysis combined with that, fundamental analysis is looking at what the company has done, how the company has performed. The thing about fundamental analysis is that it is subjective. Fundamental analysis 100% is subjective. Now, we can do some things with technical analysis that allow us to be more objective. Objective meaning it becomes more mechanical. We get an indication. We know that price is objectively above a particular level or below a particular level. Case in point might be to a serious question, which is, how do you know if you've got a higher high or a lower high or a higher high or a higher low or a lower low? Objectively, it's where price is relative to those previous levels. That's not up for debate. It's not up for question. It is objectively the case. So technical analysis can give us some decision-making understanding, right? Fundamental analysis, subjective and up for interpretation. And you got to remember that both technical analysis and fundamental analysis is based on the behaviors of human beings. Technical analysis is based on the behavior of other traders. Fundamental analysis is based on the behavior of people at the company in putting together the information that they put out in their earnings announcements and in that fundamental information. So there is a certain amount of subjectivity to that as well. All right, so let's talk a little bit about this idea of trend. First of all, the idea that price moves in trends, bullish, bearish, and sideways. And over any particular period of time, we can see a couple of different things going on. Over any particular period of time, we can see price moving in a trend. And we can pick out that trend. Now, will that trend continue? We don't know. There's a lot of mythology that goes along with this, and there's a lot of platitudes in the market, things like the trend is your friend until the end of the trend. And that's true. Trend is likely to continue until it doesn't, until news changes that. The next part of this is the market discounts everything. So that's kind of the confluence of fundamental analysis and technical analysis that I come to, is this understanding that the market is assumed to know all of that fundamental information, and whatever they're pricing the stock at the current time is the representation of current collective market knowledge, including all of that fundamental information. So they might know, yeah, this company is terrible at managing their cash flow, but they're still willing to price their stock more expensively than other people might expect, right? So here's the thing, and I'm going to ask the question out here, out in the chat. Do you suppose that there might be companies that are undervalued relative to their price, relative to the price of the stock? Undervalued, meaning the net value, the net asset value, the book value, whatever fundamental analysis you want to come up with, is less than the price of the stock. Yeah, 100%. I like what Josh says. Yeah, for sure there are. Are we still okay buying those stocks? Right? Yeah. Because what it's currently valued at is what the market assigns that price to be. Now, are there companies that are overvalued relative to what their current price is? Yeah, for sure. Likewise. There are companies that maybe are those diamonds in a rough. But here's the thing, and to Ricebird's point, finding those. We as technical analysts, we as technically driven traders, I think spend way too much time trying to find the diamonds in the rough, instead of simply making decisions about what's going on right now in reality. So being able to say objectively, if this happens, then I know what I'm going to do, or if something else happens, then I know what I'm going to do, helps us to use technical analysis to make informed decisions. So as JD says, Yeah, Tesla might be overvalued, Palantir might be overvalued, but the price is still going up. People are still willing to buy it. And if that's the case, then we can make a decision about it without necessarily believing in this idea of valuation, because valuation is subjective. So it's a good thing to think about, right? Kind of a good thought process. Now, there's another element to this in terms of technical analysis, is that history repeats itself, or it tends to look similar. The market, and I don't care if the algorithm is written a particular way. I don't care if it's an algorithmic trader. I don't care if it is a trader who is simply looking at a point and figure chart on a piece of graph paper and making a decision based on what they've plotted by listening to the radio and getting stock prices. The behaviors of human beings will tend to be similar in similar circumstances. That's just human nature. And human nature still drives AI machine learning, algorithmic trading, and really, if we think about it, that phrase that I just gave you, if this then that, is a very simple but effective algorithm. So if we behave the same way on an ongoing basis, we behave similarly. Now, what that also takes into account is the fact that human beings can be irrational too. We can have beliefs that are irrational about price or about movement or about trend. And it's that irrationality and fallibility of humans that allows for price movement to be different. If it were not, and I will say this, and this is a hill that I'm willing to die on here at this point when it comes to technical analysis, if algorithms, if AI were, there's no question they have changed and will change the nature of trading. But if they were trading outside of that human infallibility, then what you would have would be static price action. Price would not change because those algorithms have the element of human knowledge and human behavior involved in them because they were programmed by, written by, taught by human beings. They have fallibility and they allow for price movement to happen. Okay? All right. So I will get down off my soapbox here for a minute, but let's talk a little bit about the benefits and risks of technical analysis, and we'll jump into some of the tenets of it. Potential benefits. Some people find looking at a chart fairly intuitive to see that price. Some people do not. And I'm going to use my wife as an example to illustrate this. And my wife is phenomenal. I love her dearly. But sometimes in looking at spatial relationships, meaning not special relationships, spatial relationships, looking at the relationship of one object to another, that's a challenge for her sometimes in terms of what can fit someplace or what might move something else. Some people that comes intuitively. And so technical analysis depends on the idea of looking at a chart and seeing something. Now that can be trained, and that's what we do. That's why we have as many technical analysis webcasts during the week as we do. That's why we teach technical analysis out on the road in our live workshops. But technical analysis is flexible. It can be applied in any market condition. It can be applied across a variety of financial markets. I taught a futures trading class this morning where we talked about technical analysis using futures contracts. But there are risks. Humans have cognitive biases, meaning not being able to understand that a higher high is a higher high relative to a previous high, for instance. That's a cognitive bias. Trends are often easier to see in hindsight than they are to project into the future, again, with that element of news. And technical analysis is open to subjectivity because it requires discretion to interpret. Some elements of technical analysis are that way. So let's talk about that idea of technical discretion versus non-discretion. So a technical analysis concept that is discretion might be drawing a price pattern or a level of support or resistance that requires human interpretation. It incorporates our bias, and it might be difficult for others to replicate. For you to see the same levels that I see when I draw levels of support and resistance is maybe difficult for some. And we try to make it as easy as possible. Non-discretionary, computer-generated signals that don't require human interpretation, such as if I've got a previous high and now the price of the stock is printing at a price that is higher numerically, mathematically, than that previous high, then guess what? In a non-discretionary way, that's a that's a computer-generated signal. That's an indication that that is a non-discretionary higher high. Now, we won't know that until after the fact. But non-discretionary information, methodical, removes that bias, doesn't adjust for nuances or uncertain circumstances or the phases of the moon or how you're feeling that particular day. It should be replicable. So there are elements to technical analysis that fall into both of these camps, discretionary and non-discretionary. So there's kind of a defined, repeatable formula that we talk about a lot about. You'll hear it in Scott Thompson's Trading Stocks for Beginners is what his webcast is called. You'll hear it in Brent Moore's trading options webcast, or his managing an options portfolio webcast. You'll hear it in my trading futures or my trading index options webcast, or in Rachel Dashiell's trading long options webcast. You'll hear these same elements. What are the instruments that we're going to trade? The watch list criteria. What to trade? How do we get into the trade? How do we manage our risk in the trade? What do we use as a means to get out of the trade? And what are the routines that we follow on an ongoing basis to be consistent? So this defined, repeatable formula: what to trade, when to trade it, how to manage the risk, when to exit, and what to do on an ongoing basis. That basic, repeatable formula is something that helps to perhaps shape the elements of technical analysis and using technical analysis as a means to make decisions. All right, so let's talk a little bit about charts, and then we're going to go out to the Thinkorswim platform. A chart is nothing more, nothing less than a function of price and time. So our charts can give us information about price action, the movement of price over time, plotted over time, is the purest form of information that we have. Everything else, every other technical indicator out there, including volume, is an interpretation of that. But price is pure. There's a reason why we use the platitude price is king when it comes to technical analysis, because price tells us everything that we can see, everything that we know, and we assume that it incorporates all of the information that's out there in the market. Does that mean that price is infallible? No. Does it mean that price in its context is doing what price is doing? Yeah. So this is a basic line chart, just plotting closing price, connecting the dots. Oftentimes we'll use some coloring to illustrate bearish or bullish movement. Volume sometimes considered in the decision-making process, including in the bottom of the graph, used to perhaps determine the strength of a move, assuming that volume information is accurate. But we'll talk a little bit about price bars, and I'm going to kind of hold off. We're going to go through this really quickly. A bullish bar or a bullish candle is one that is closing higher than it opened. A bearish bar is one that closes lower than it opened. I don't care if that's a weekly bar, if that's a yearly bar, monthly bar, 5-minute bar, 1-minute bar, 10-second bar. Doesn't matter. We assume the same characteristics and the same bias. Bullish bar is one that closes higher than it opened. A bearish bar is one that closes lower than it opened. We'll look at this in the context of candlesticks here again in just a minute. Now we've got a high and a low. for that time period, for whatever time period is included in that particular bar or candle. There's going to be a highest price in that time period, and there's going to be a lowest price in that time period. Now, this gets back to Siri's question about highs and lows, and we've had this conversation before. When you're looking at time frames, when you're looking at the time frame to be able to determine highs and lows, if you're trying to find a higher high, you're looking for the highest price within a reasonable time frame. So whatever that reasonable time frame is, that might be dependent upon the time frame of the trend that you're looking at. So if you're looking at a short-term trend, it might be a matter of 5 or 10 days that you're looking back. If you're looking at a very short-term time frame or an intraday time frame, you might be looking at what have been the highs of the last 10 5-minute candles and looking back at those highs. And is the price making a new higher high or a new lower low in that context? Okay. And David asks a question, is the low and the high the same as the bid and the ask? No, it's not. It is not. That is the highest price or the lowest price that a trade took place. The bid and the ask might be different than that. And that's a great question to ask. And we'll look at that here in just a second when we go out to the platform. But the low and the high, not the same as the bid and the ask. They might correspond, but as a general rule, those are not the same place. All right. Good question to ask. I like that question. Now, bar chart, again, you're going to see those three things. And same thing with a candle. You're going to see an opening price, closing price, and you're going to see the high and the lower that defines the range of the candle. So we'll talk about this in the context of candlesticks, but generally think about this. In the majority of the ways that we evaluate candles or bars, bullish candles or bullish bars are going to be green. Bearish candles, bearish bars are going to be red. Okay? So if that's the case, a green bar is going to be, or a green candle is going to be green because it closed higher than its open. A red bar or a red candle is going to be red because it closed lower than its open. And that's what determines those colors. And it doesn't matter if it's green or red. You can change the colors up to match your favorite football team if you want to. That's fine. Now, a candlestick just kind of draws in the information here and kind of fills in the gaps. You can see if this is a red candle, or a red bar, that was the open, this was the close, and it becomes a red bar. This is the open, this is a close, it becomes a green candle in this particular case. So you can see how that information gets filled in. Highs and lows are always going to be the highs and lows within that time frame. Sometimes the high is the closing price, sometimes the high is the opening price. Depends on the color of the candle, but highs and lows are always going to be the highs and the lows for that time period. Now, let's get into a little bit further this candlestick construction. A bullish candle, opening price, lower than the closing price. Bearish candle, closing price lower than the opening price. Oh, it opened higher and went down, or it opened lower and went up. That's going to give us bullish or bearish candles. And they can give us some information. Just like those bars do, they can give us some momentum information. When we get big candles, that's a lot of momentum in one direction or the other. It doesn't matter if it's red or green. If we get small candles with that small body, that's an indication that there's not a lot of movement going on. There's not a lot of momentum behind that candle. In fact, there's a little bit of equilibrium or balance in that candle. We'll talk more about that as we get into this discussion. Now, if we start to look for this information in a price chart, that's where charting tools like the Thinkorswim platform can help us. So we're going to jump out to the platform here in just 1 second. I want to cover one more thing in this discussion, and that is time frame, because we've talked a little bit about it. The longer the time frame that you're looking at, the slower generally the signals are that you're going to be looking for number one. And number two, the more information those signals will incorporate. So if you're looking at a weekly chart and you're a longer term investor, those charts are going to have more information included in them because each one of those candles represents more time. A daily chart, looking at maybe an intermediate or a long-term time frame, those are taking into account 1 day of information in each candle. Not as much data, but certainly more data than if you were looking at an intraday chart, maybe at a 1 hour candle. So that's kind of the element here. Longer term trader, longer charts. Shorter term trader, shorter aggregation period on your chart is generally the way things go. So think about this. When we talk about technical analysis, in most cases here on these webcasts, we're looking at daily charts over about a 1 year time frame. And some of the time frames that we might apply to that. Longer term time frame might be months to years. Intermediate time frame might be weeks to months, and a short-term time frame might be days to weeks. Now, if we were to shift down to a shorter-term time frame to where each one of those candles represented 1 minute or 5 minutes or 15 minutes, then it's going to be similar, but it's just going to be a shorter time frame. Same thing with the longer-term chart. If we were to go out to a weekly chart and each candle represents a week, now we're talking about months to years to decades, maybe, in terms of that length of time. So that's one of the great things about technical analysis, is that it can apply over a variety of different time frames. So the last thing I want to talk about here in this context is the idea of volume. And volume is a confirming factor. And I'll get to your question, Doopy, here in a second. But volume can be a confirming factor. It can help indicate or illustrate the strength of a move. Doesn't indicate direction. There's nothing that tells us that this is buying volume versus selling volume. That is interpretation. There's no such thing as volume that is buying versus selling volume, because we assume that there's going to be a transactional balance, right? That if for every buyer you're going to have a seller, and for every seller you're going to have a buyer, if a transaction is happening. So it can indicate perhaps some of the strength of a move or the participation in a move, but it doesn't generally say that there's more buyers than sellers or more sellers than buyers. That's mythology. So for instance, an up day with big volume might be considered to be a stronger bullish indication than an up day with low volume. And likewise, a down day with high volume, stronger bearish indication than one with lower volume. Participation, not direction. And the idea is here too that this participation is what the institutional traders want us to see. So let's do this. Let's pop back over here to the Thinkorswim desktop software platform. Let's take a look at the S&P 500. This is the SPX, the S&P 500, and I want to kind of go through some of these elements here. So I'm going to remove a couple of these lines that I've drawn on this particular chart. This is a 1 year daily chart using candlesticks, and each one of these candlesticks represents 1 day of time. So what I want to do is I'm going to grab my magic marker. We're just going to grab a couple of these prices here along the way. We're going to draw highs and lows. So let me grab that real quick. Magic marker, there we go. There's a low, there's a low, there's a low. How do I know it's a low? Price came back down, turned around at that point. There's another low. There's another low right there. There's another low right there. There's another low right there. There's one right there and right there and right there. And there's another low right there. Now, where are the highs? Right? Where are the highs? There's a high right there. And 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 there's a high right there. Remember, we talked a little bit about this last week when I talked about pointing out those highs and lows on a chart. There's a high. There's a high. There's a high. There's a lower high right there. There's another high right there, roughly equal high. there's a slightly higher high. So what I can do is I can look at this and I can say, hey, you know what? I can say that since April, the SPX has been in a long-term uptrend. How do I know that? It's been making generally higher highs and higher lows. Cool. That's easy to understand and see in a chart like this when the price is moving in a particular direction. When that trend becomes evident, it becomes more difficult, though, on the other hand, if we were to do this and we were to turn our time frame down a little bit, let's put this on a shorter time frame. Let's go to a, say for instance, a 20-day 1 hour time frame. Or let's go down, say for instance, to a 5-day 5-minute time frame. And you say, wow, where's the trend here? Well, we still have trends. They're just shorter time frames. There's just shorter time frames to these trends. I still have periods of lower highs and lower lows, or periods of higher highs and higher lows. And now those levels get broken. Now, where those dots connect, or where those lines connect with prices, those can be considered to be levels of support and resistance. We'll talk a little bit more in this cycle about support and resistance, but think about those levels as indications of where buyers have collectively made a decision to do something, either step in and buy or step in and sell. So when we start to look at trends, and if we zoom back out, say for instance, to our 1-year daily time frame here, and we say, hey, you know what? I can see that there have been a couple of these lows right along this area here. Price came down to that level and bounced. Price came down to that level and bounced. Price came down to that level and bounced, probably acting as a level of support. And if I see areas where price has changed direction in the other way, so it ran up to that level and bounced down, ran up to that level and bounced down, ran up to that level and bounced down, that's probably a level of resistance. Now let's talk a little bit more about candlesticks here as we get into this. And let's dig in a little more deeply here. So I'm going to zoom in and I'm going to take a look at some of these candles. So a big down candle like this, big red candle, means that it closed lower than it opened. And that's a big momentum candle. Now, Dupy asked the question, well, what would be a confirmation candle? What would be an indication of a confirmation candle to this downward move or a break of that support? A confirmation candle on that big red candle would be a continuation of the move, confirming something happening, breaking through that level of support. But if we were to see something like this, let's zoom in on this time frame right here. We see a big red candle down to a level of support, and then we see another candle, the next candle that comes up off of that level of support. What's that telling us? That maybe buyers are stepping in and pushing prices higher. What would be the confirmation candle? Right here. That next candle that moves higher. So we talk a lot about this idea of say, for instance, looking for confirmation, right? You'll hear it referred to sometimes as close above the high of the low day or close below the low of the high day. All we're looking for is evidence that price is moving in a particular direction. So we could even call this a new higher high in the context of this high right here, because the high for this candle, this next candle that we saw occurring, was above the high of the previous candle. We're getting confirmation of that movement. Now, does that mean that if we had a day like this, we had a bounce up off of a level of support, we had a confirmation candle, does that in any way, shape, or form guarantee that the next candle is going to be higher? It does not. And so we need to be aware of that. We need to be prepared for that. Okay. So here's the thing. And I understand your point, JD, in terms of the names of the candles. The thing is, it helps if you understand what the candles do and what they're telling us. The nice poetic names to the candles, that supposedly came from the Japanese rice markets. That's great. And they give us kind of this nice poetic background and backdrop to this. But I think it's more important to understand that a big candle is a momentum candle, a little candle is a balance candle, and sometimes you get these transition candles that help to move price one direction or the other. And as we'll get deeper into this discussion, when you start to see those wicks or shadows that define the highs and lows, that can give us some indication about price movement. So I'm going to choose one more stock here. I'm going to go to this one, Disney. And we're looking at this on a one-year daily chart. This is a one-year daily chart. And from this perspective, we've got price that's gone up and price that's gone down, price that's gone up, price that's gone down. This is a good indication of that idea that there is no guarantee, because we had price moving higher. In fact, it broke above a resistance level. It was a big, strong momentum candle, and then news happened. The news was an earnings announcement, and the price went down. The market reacted. There was no way of knowing that that was going to happen until after it happened. So a trader that had entered a trade here and said, fine, I'm going to go long this stock, might have protected their risk by putting in a stop order that may very well have been triggered once that news happened and the market reacted to it. So I want to throw one more element into this mix, and that is volume. So I'm going to come over here to the gear icon. I'm going to go to equities, and I'm going to show the volume subgraph down here in the bottom. Now, sometimes these candles are painted, or these bars are painted the same color as the candles. That's the interpretation of bullish or bearish. But when you start to see volume spikes, right? These spikes above average volume, that can tell you that there's some activity going on. There was a lot of activity going on around this earnings announcement. There was a lot of activity going on around this last earnings announcement. There was a lot of activity going on right here when the price was down on that level of support. That doesn't tell me anything about direction. That does not tell me anything about direction. It just simply gives me a level of participation. Yeah, Josh, you're absolutely right. At the end of the day, that's what it comes down to, is managing your risk. Because we didn't know what was going to happen there. Even volume didn't tell us anything. Because look, if we came to right here, let me just kind of zoom back on this. That's a resistance level breakout with big volume. What happened the next day? Boom. Yeah, down below that level of support. So let me wrap this up. We've got a lot to talk about when it comes to technical analysis in this context, in terms of the discussion of all of the elements of technical analysis. I've been doing this for over 20 years, and I have nowhere near scratched the surface of technical analysis. But I want to give you some resources to be able to do that. The first is go to the Trader Talks webcast page, click on subscribe when you get there, and type in the word technical analysis. And you're going to find literally dozens of webcasts that talk about technical analysis, including this one. Technical analysis, the basics, start here. It's what we teach in the live workshops. The first day is technical analysis. So that's a great way to follow up and continue this discussion, continue with the next step in this webcast. And then I've got something special for you coming up tomorrow, actually Thursday. We've got our Schwab Coaching special event, the 2026 Market Outlook. We would love to have you join us. It's going to be on the Schwab Network. You can find that right here on Schwab Coaching, or schwab.com/coaching. Go to live webcasts and virtual workshops. But that's going to be Joe Mazzola, Lizanne Saunders, Kathy Jones, Colin Martin, and others that are going to be providing some great information. My thanks to Bree and our producers for helping to bring this to you. My thanks to Brent Morris for helping out. And most importantly, my thanks to all of you for listening to this discussion. And we'll continue this thought process in session 2, which talks about trend and time frame. Thanks for joining me, guys. We'll see you very soon. Take care, everybody. Bye-bye.